Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glen Sutherland.
Welcome to a new episode of A Canadian Investing in the U.S. with Glen Sutherland. This week, my guest is Big Mike or Mike Zlotnik. Mike, you want to start off by giving everybody a bit of an introduction to yourself?
Thank you, Glenn. I appreciate you. I live in Brooklyn, New York. I am a Big Mike. I'm 6'4", and I have a podcast with a cheesy name, Big Mike Fund Podcast. I grew up in the former USSR. I immigrated to the United States in 1989. I'm a U.S. citizen, U.S. patriot. I have many Canadian friends. I used to work even some parts of Canada. I used to live upstate New York and travel to Canada. I used to live in Rochester, New York, and I traveled to Canada, Niagara Falls, Toronto, all the fun stuff. Mm-hmm. So Canada is like a big brother to me, very friendly. I think U.S. and Canada, they should be brothers. So Canada is dear to my heart in many ways. Wonderful wife, 4 monkeys and a cat, 4 human monkeys, 4 kids. I am a 15-year technology professional, retired from technology. I had a great journey. And I've been doing real estate full-time since 2009 and part-time investing since 2000. So it's been a fun journey investing in real estate. Happy to chat on any topic in real estate.
Yeah. And just based on the podcast name, Big Mike Fund, I'm guessing you're running a fund. So where it runs in my head is, where are we in the real estate cycle right now? And it doesn't make sense to invest in funds. Does it can't talk today, but does it make sense to invest in single family homes? Does it make sense to invest in something completely different? Where are we on this cycle? What makes sense right now?
Yeah, it's a great question, and recognition of market cycles is one of the most powerful ways to invest. So I am a big fan of Howard Marks' Mastering Market Cycle. He talks about stock market cycles, but real estate market cycles obviously take place. And we just seen a massive reset. So real estate was in an expansion cycle when interest rates were very low. From the bottom of the market in 2008, we had a long expansion with a blimp of COVID. Ultimately, it ended in 2022. We had a fast and furious reset with interest rates going up from zero. Cocaine. It's the cocaine of real estate. Zero interest rate policy, ZIRP. The Federal Reserve and many other central banks have given us this cocaine for long enough. And then when they withdrew the cocaine, there was a massive reset. So what we do see today, last few years have been markets sort of in a very low transaction volume, very skittish, concerned investors, market valuations resetting, liquidity pressures. We are finally, in my view, and this is a crystal ball discussion, but it feels like we have absolutely hit the bottom of the market and we started the recovery. And we started the recovery for a couple of reasons. And we'll talk about there are different subclasses in the market, right? Commercial real estate and residential market. Residential market, interestingly enough, some parts of the residential real estate has not corrected. The values have not fallen. Some other markets have seen that falling. Commercial, you've seen a lot more reset. Why? Because commercial depends very much on the level of interest rates. So multifamily has seen a huge reset to the degree between 20 to 40%. Now, it's a huge number, but that's the reality today. Number of other asset classes, we do quite a bit of investing in open air shopping and industrial. And these deals trade on a spread between the interest rate and then the cap rate and the interest rates. I'm not sure if you're familiar. And that spread is about 150, 200 basis points or 1.5%, 2%. As interest rates rose, so the cap rates rose and the prices fell. This is as simple as it gets. Where are we in the cycle now? Well, we just saw the Fed make the first rate cut after pausing for quite a while, right? So it's the first quarter. They set forward guidance to make another 2 cuts this year, and likely multiple other cuts next year. Jay Powell, Fed chair, retires in May, and President Trump is going to nominate a much more dovish Fed chair who's going to cut more. So from an interest rate perspective, we don't know exact speed of cuts, but we know they're coming. And it's likely we're going to see between 150 to maybe 200 basis points cuts between now and the end of next year. Now, this is all speculative in nature, but it's probabilistic. right? And then on the 10-year Treasury yield that controls the mortgage rates, we're probably going to see some level of interest rates compression. The yield curve will expand. I know it's a fancy term. It just means the difference between the long maturity rates and the short maturity is going to widen. So 10-year can fall by 50 basis points or 0.5%, while the short end of the curve, the Fed funds rate, can fall 1.5%. So all this fancy talk, what's the conclusion? The conclusion is there's a significant tailwind to commercial real estate. Plus, in the United States, the new tax law, the one big beautiful bill, restored 100% bonus depreciation. That is very significant incentive for people to buy commercial properties and run cost segregation study, get the tax deduction. So on multiple fronts, I see recovery beginning to pick up momentum later part of this year into next year. So from a cycle perspective, that's what it feels like because there's a significant dependency to the interest rate on the commercial real estate. Now, it might take a little time for the problems deals to cycle through the system, and not every deal is going to be a great deal. But the few selected great buys financed today can be phenomenal investment on a forward outlook for the next 3 to 5 years.
Yeah, because then ideally the cap rates could go down.
Compress, yeah.
Compress,
so if you underwrite based on current cap rates, you'll be fine. I mean, you'll do really well when the rates fall.
Yeah. And for some people, like honestly, just even hearing you say that, and a lot of people do get very confused when they hear about like the Fed rate dropping, and and they don't understand the relation between the Fed rate, the Treasury, and then the mortgage rates. Would you be able to explain that a little bit more to people just so they understand that? Because a lot of people, they hear, oh, the Fed dropped their like quarter point, and then they're like, why didn't that affect my variable rate for my mortgage? Are you looking to invest in the US? Are you looking for a coach rather than a coaching program? Well, you're in luck, because that's where my coaching program is completely different. It's not about just teaching you all the material. It's about like having a community of people all doing the same thing. It's about doing one-on-one calls with me to strategize, to plan, to look over deal analysis, to check markets with you. Just honestly, just to solve mistakes before they happen. If that's interest to you, you want to learn about the coaching program, or you just want to do a one-on-one call with me just for like 10 minutes, just to answer a couple questions, just to get to know me, go to my website, glensutherland.com, or at CanadianInvestingInTheUSA.com, and you can book a call right at the top. And I'd love to get on the phone with you and just even get to know everyone.
So it's a great question, and there's basically two answers. So the Fed funds rate, there's another index called SOFR, and it's linked to the Fed funds rate. And many variable mortgages or floating rate mortgages are connected to that rate. So when the Fed moves the rates a quarter, SOFR moves a quarter, and these mortgage rates that have SOFR plus 3%, their rate adjusts accordingly the next month or as soon as it happens. So the Fed funds rate changes impact floating rate mortgages, variable rate mortgages. It affects bridge loans, which are used for value add projects, which are used for ground up construction, for heavy redevelopment. That's what you see. In the residential space, that's rarely used, right? The residential space, most of the mortgage rates are tied to the 10-year Treasury yield. So 10-year Treasury yield has a mind of its own. It's a market force driven supply demand for bonds. And we saw it last year. The Fed cut interest rates a year ago. They did 3 cuts, and the Fed funds rate was reduced from, it's called 5.5 to 4.5. And the mortgage rates actually spiked. This is the crazy part. So what it says is the market has a mind of its own. It can react to the inflation expectation. So the 10-year Treasury yield very much depends on factors that are not always tied to what the Fed does. It is tied to the market sentiment, where the inflation is going to be, where the economy is going to be. So the relationship between what the Fed does and the mortgage rate is the following. It creates substitution effect. So as Fed cuts interest rates, what happens is the interest rate on demand deposits, on what you have in the bank, falls. Or people who have short maturity bonds, they basically, when the notes mature, they have to deploy cash. and they wind up buying longer maturity bonds. So this is very sophisticated verbiage, but what it really does is when the short maturity rates fall, it puts downward pressure on long maturity rates as well.
Yeah, so just kind of compounds between the different things. I love it. So for people who are passive investors, and they're looking for something that's going to be, safe, predictable, where would you advise them to put their money in something right now?
Sure. So I'm not an advisor. I'm not CPA. I don't play one on TV. Always talk with your professional. But to make long story short, in my personal opinion, I see there's few great areas of opportunity today. We've seen this quite a bit. Basically last year, maybe last 2 years, but also we see a whole new wave of new deals. First of all, I call it deep value commercial real estate. You can buy deep. So you could play equity, even though you're trying to be careful and downside protected and as safe as you can. And you can do it in equity on the deals that get bought at a steep discount to what the past value was to the current cash flow. So give you some examples.
Yeah.
You could get into some deals that used to trade multifamily, 125 a door. Today they trade for 79,000 a door. When you buy at a big discount and you buy at a cap rate of 9%, you finance at a 7%. And on top of that, you buy the discount of reconstruction cost. It costs you 79,000 a door to build new. It costs you 200,000. If you underwrite well, you can create downside protection through very, very smart underwriting. Plus, every deal today, in my view, must have great cash flow from start. That's why we do very little new development, because I can't get a discount on new development, but I can get a discount on existing. So if you are a very prudent, smart investor and you look for deep value, you could absolutely get it today, and that's part of your downside protection. Now, there are also multiple deals, multiple strategies that are just inherently downside protected. To give you an example, we're working on a series of triple net, absolute triple net industrial deals. Yeah. So what the hell is a triple net industrial deal? Well, it's a deal where the investment buys real estate. It's an industrial property. Quite often, it follows domestic manufacturing. So some of these properties, literally you have a domestic manufacturer in the property. Sometimes the company gets bought, and the new owners, they don't want to own real estate, so they'll sell real estate and immediately lease back and sign a 25-year lease. And these triple net leases, absolute triple net leases, they have all the increases in taxes, insurance, the roof, any other expenses. They get passed to the tenant, not the owner of real estate. And many of these leases have 2 to 3% rent escalation clauses. So when you buy, let's use an example, at a cap rate of 8, you finance at 6. You have positive spread from day one, and every year it increases 2 to 3%, and all the costs are passed to the tenant, which you have, and you borrowed with fixed rate mortgage for, call it 10 years.
Yeah.
It almost works like a predictable engine. There's no better way to put it. So that's why we love these type of deals. We love industrial, we love open air shopping, because high credit quality tenants with long duration leases, with predictable rent escalation clauses create predictability. You ask for the word predictability, I'm giving you, this is predictable.
Yeah.
So these are couple of strategies that people have used. Of course, you can get predictable income being a lender, debt. I mean, you could still continue to do hard money loans, but the challenge is with that, you can get good returns today, but what if the rates drop? Then your yield will come down with these falling rates. So we like to be equity today, very predictable, as I said, industrial, open air shopping, some multifamily, depending if you can find a great deal.
Makes sense. So I just made some notes here, and I'm just going to read them back, and then you can tell me if I made a mistake here. If you're, for people who are passively looking to go and invest or put some money into something, if they're looking for, like, to invest in someone else's sort of multifamily or, flex or whatever their, some sort of commercial style investment in a fund or syndication, really they should be looking for the operators buying this at a steep discount. So if it's, multifamily, a steep discount on the per unit amount, right? So if you said, I think I said 125. Have you been thinking about investing in the US, but wondering if these numbers actually pencil out? So I created a deal analyzer exactly for that reason. So if you're interested in it, completely free, go to accanadianinvestingintheusa.com/deal.
Three primary underwriting. I'll recap. So when we underwrite today, we look at three things,
Yeah.
right? One is positive spread between the cap rate and the interest
Yep, I
rate,
got that one.
200 basis points. Second, it's the price today versus the peak of the market. And why we use that is because the current market might have very few limited comps. So the comps, the volume that's transacting is very limited. You can't exactly establish the market,
Right.
but you can compare to where it used to be. So when I see 35% off the peak, I know the current range it's in a good part of the range. And then the third is price you're paying for per square foot or per door relative to the reconstruction cost. You have to, of course, adjust for the condition and the age of the property. So all these basic factors can help you underwriting decision. As far as what to invest in. So you started with a fund conversation, and forgive me, I deviated. I didn't answer your primary question.
okay.
Yes, we do funds. We love funds, but today we love even more syndications. And I'll tell you why. Syndications are one-off deals, and majority of investors today prefer to get clear, concise understanding of what they're investing into, right? Of course, it's jockey ahead of the horse. They need to get to know Big Mike. If they don't like Big Mike, they can never write the check. So know, like, and trust who you're investing with, number one. Number two, what are you investing into? And you have to get very clear understanding how the project is going to make money. Obviously, location matters. What is being acquired at? How do you know it's a deep buy today? And what is the strategy for the next few years? The more predictable it is, the more I like it. The more heavy work it requires, the less I like it because uncertainty of execution. So today we're looking for certainty on the buy and certainty of the execution. And yes, it's syndications, which work as a limited partner, general partner type of deals. And we have many Canadian investors. And I'll just tell you this. One wisdom I've learned working with Canadian investors, not a tax CPA, not a tax advice, but what I've seen is Canadian investors writing direct check versus setting up a US-based C Corp, which owns a US-based LLC. The reason it's important is when these deals make money, you don't want IRS to force sponsors to withhold profits, and then you got to go and fight for that money back. So it's a very important if you set up an investment as a non-US investor, having a US C Corp loan the money to the Corp, and then have a subsidiary LLC, and then all the stuff becomes a US tax IDs, US entities. And from a tax perspective, you have a much better setup, at least consult with a professional. But I've seen this live when deals, people made mistakes. They've given us checks from Canada and they have profits. And then I have to send a check to IRS. And then they say, wait a minute, that's part of my profit. Well, IRS requires withholding for a non-US investor. So just a small nugget.
Oh yeah, no, I always advise that set up some kind of entity when you're buying in U.S. real estate, just because then you're dealing with U.S. laws and not having the tax withholding, the FERPTA, or any sort of investment withholding. You just don't want to you don't have to deal with all of that. No, those are great tips. You said off the start you were located in Brooklyn. The fund, the in syndications or the projects that you do yourself, are they located in New York as well, or do you invest abroad?
Wide majority of what we do is completely outside of New York City. So what we invest in where they're great deals, and the way we actually act as fund managers or capital partners on deals. We don't operate these assets directly, but we know all the best jockeys. So when you invest in a fund, one of our funds, we write checks into deals. When you invest in syndication, we bring these deals to you by actually finding the deal with a great operator in a great strategy in a market. So I'll give you an example. Early in the year, we brought a deal near Ann Arbor, Michigan. It's not that far from Canada.
Nope.
So it's a great area. University of Michigan, obviously, it's a great community. Over 1,000 doors on a beautiful lake, Belleville Lake, and that project was brought to us by an operating partner. All they do is suburbs of Michigan, Indianapolis, and a few other cities, Midwest. So we do quite a bit Midwest. We do number of deals in other parts of the market. We just did an open air shopping downtown San Diego, literally at the seaport. So the way it works is we are connected with the people, the operators, vertically integrated operators, specialists in each strategy, and they find a great deal. They call us and say, hey, I'm raising $20 million. Do you want a piece? And we say, yeah, we'll take a piece if we like the deal. So we underwrite the deal, and then we bring it to our investors. So essentially, when folks invest with us, it's not New York City, it's heavily many other parts of the country. And it's a function of where there is a great deal. So we are not geographically focused. We are focused on who is the jockey, and where the deals are and why it's a great deal. So if you bring me a deal in anywhere in the country, we have certain rules. For example, I don't like residential in New York City for the reason of rent control laws, a number of other things that essentially create it difficult, or California. But will I do a commercial deal in New York City? Sure. We actually have a redevelopment in New York City. We're redeveloping a 20-door apartment complex into a single-family townhouse. It's going to be 17,000 square feet next to Central Park. So it's an example. It's going to be a project like this. So that project we don't do a lot of developments. This is a one odd bird that we invested into. So most of what we do, as I said, cash flow focused, predictable, downside protected. We try to avoid speculative stuff, and we love Midwest as an area, but we'll go south. We'll go over various parts of the country.
Makes a lot of sense. People who are listening to this, Mike, and they're like, "Hey, I like what you're putting down. How do they find you? Where's your podcast located? Do you have a website? How do they find you?"
It's going to get very easy and very cheesy from here, right? So I go as a Big Mike. People have called me Big Mike for a long time. I am 6'4". I'm a big guy.
Yeah.
And years ago, I started podcasts, just like you're running a podcast, right? Years ago, I started a podcast, and I could not come up with a fancy name. So one of my close friends just told me, you're Big Mike and you're a fund manager. So call it Big Mike Fund Podcast. So the website is bigmikefund.com. And if you misspell it and you forget the D at the end and you go to bigmikefund.com, I promise it's not a kinky site.
Oh, okay.
That's the easiest way to reach out. Yeah, from there you can get to the corporate site, but it is a podcast site, and there's a link to the corporate site.
Awesome, Mike. I appreciate this. I think that this honestly is one I'm going to have to listen to myself. A lot of times when you spit a lot of terms, you just got to make sure you fully understand everything that you're talking about. But there was a ton of information, and a ton of. I loved your insight on just where we are in the market. So I think this would be helpful to a lot of people. I appreciate that.
Glenn, you're too kind, and I have this another expression. So if you're bored, you got nothing else to listen to, then you go to bigmikefund.com.
Thank you for coming on the show, Mike. I really appreciate it.
Thank you, Glenn. Appreciate you.
That was a nice video. Bye.